7 in the morning of October 17, 1987, I received a call from our main trader saying that the market was crashing and we couldn't sell anything. That day, the Dow Jones fell 22.6% in 6.5 hours of trading. 22.6% in a single day. I saw $100 million fortunes evaporate to $30 million before lunch. But here's what really stuck with me that day. It wasn't the speed of the collapse, it was the uniformity of the psychological errors that led to it. I talked to dozens of investors in the weeks that followed, and everyone, absolutely everyone, made the same 5 psychological mistakes in the weeks before the crash. Fast forward to September 2008, when Lehman Brothers imploded, and I saw the exact same 5 psychological patterns destroying portfolios that had taken decades to build. And now, in January 2026, after 45 years of studying investor behavior through 12 major crises, I am seeing these same 5 mistakes happening on a larger scale than I have ever observed. The difference is that now it's not just professional investors making these mistakes. There are millions of people with easy access to trading apps, cryptocurrencies, options, and leverage that amplify these psychological errors to devastating proportions. Let me be brutally direct with you about what I'm seeing. These 5 psychological mistakes are not about lack of information or poor analysis. They're about how our brains are wired to make terrible financial decisions, especially when markets are at extremes of euphoria or panic. And what concerns me now is not that people are making these mistakes, it's that they are making all 5 simultaneously with levels of leverage and exposure that make the consequences irreversible. And if you're not already subscribed to the channel, subscribe now, because what I'm going to share over the next few weeks about how to reprogram these psychological patterns could be the difference between building generational wealth and losing decades of work over the next 12 to 24 months. The first psychological error that destroys assets is what I call normalcy bias on steroids. It is the tendency of the human brain to believe that the near future will be basically the same as the recent past, especially when that recent past was comfortable or profitable. Let me show you how this works in practice. Between 2003 and 2007, I saw hundreds of smart investors buy houses as investments because real estate had been rising consistently for 4 years. Their brain linearly projected that if real estate went up 12% a year for the last 4 years, it would go up 12% for the next 4. Pure normalcy bias. The problem is that this projection completely ignored that the last 4 years have been abnormal, driven by easy credit and artificially low rates. When I asked one of these investors in June 2077 whether he thought it was sustainable for housing prices to grow 3 times as fast as wages indefinitely, he looked at me confused and said that housing always goes up in the long run. 8 months later, his portfolio of 5 investment properties worth $1,400,000 was underwater, with mortgages worth $1,600,000, and he was unable to sell or rent. Normalcy bias had cost him $200,000 in equity and another $300,000 in mortgage payments over the next 3 years until he was able to sell at a loss. Now, here's what scares me about 2026. Normalcy bias is operating on multiple fronts simultaneously. People assume that because inflation fell from 9% to 3%, it will continue to fall to 2%. They assume that because the Fed managed to avoid a recession in 2023, it will always be able to make a soft landing. They assume that because big tech has risen 40% per year over the last 2 years, it will continue to rise. They assume that because their crypto portfolio doubled in 6 months, it will double again in the next 6. Each of these linear projections ignores that we are in extraordinary conditions of debt, valuations, and monetary policy that are not sustainable. At Bridgewater, we developed a normalcy bias index measuring how much the market consensus is linearly extrapolating recent trends. This index is at 87, the highest level since August 2007, when it was at 91, 3 months before the start of the subprime collapse. What makes normalcy bias so destructive isn't that it's wrong, it's when it's wrong. It works perfectly 80% of the time when markets are trending normally. But in the critical 20% of the time, when we are at cycle inflection points, normalcy bias makes you double your bet exactly when you should be reducing exposure. It's like driving while looking in the rearview mirror. It works in a straight line, but kills you on the first sharp turn. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because I want to understand how many people around the world are recognizing these psychological patterns in their own behavior before it's too late. The second psychological error is recency bias combined with confirmation bias, creating what I call the mistaken conviction feedback loop. It works like this. You make an investment decision, say, buy shares in an AI company, because you believe AI will revolutionize everything. In the first 3 months, the stock rises 25%. Your brain interprets this as confirmation that your thesis was correct. Recency bias makes you give disproportionate weight to these 3 months of positive performance. Confirmation bias makes you actively seek out news and analysis that supports your position and ignore or dismiss contrary information. These two biases feed off each other, creating growing conviction based not on objective analysis, but on repeated confirmation bias. Let me tell you what happened to a fund manager I met in 2020. He put 40% of his fund into 5 tech stocks in March 2020 because he believed the pandemic would accelerate digitalization. In the first 6 months, these positions rose 120%. Recency bias made him interpret this as the genius of the thesis and not luck of timing. Confirmation bias made him read only bullish tech reviews and interpret any news through the lens that confirmed accelerated digitalization. In January 2021, he increased his concentration to 62% of the fund in these same 5 positions because his conviction had grown in proportion to the returns. The feedback loop was complete. Over the next 12 months, between November 2021 and November 2022, these 5 positions fell by an average of 73%. His fund, which had $450 million under management, shrank to $180 million. Half of the investors withdrew. 3 years of extraordinary returns were erased in 12 months because recency bias and confirmation bias created conviction detached from fundamentals. Here is the brutal math of the mistaken conviction feedback loop. When a position goes up 50%, you feel like your analysis is 50% more correct. When it goes up 100%, you feel like you are twice as smart as you thought. But markets don't work like that. A position can go up 100% for reasons completely different from its original thesis. Or worse, it can go up 100% in a bubble that eventually corrects 150%. Recent performance does not validate the thesis, it just shows what happened recently. But our brain can't separate these things naturally. At Bridgewater, we counterbalance this by forcing what we call adversarial analysis. For each significant position, we assign someone to build the best possible case for why we are wrong. Not a superficial case, but genuinely the best counter-argument. This breaks the feedback loop because it institutionalizes confrontation with confirmation bias. Without this, the natural default is to read 10 articles, find the one that confirms your vision, and feel like you've done due diligence. The danger in 2026 is that social media algorithms and news feeds are literally programmed to feed confirmation bias. If you buy Tesla, your feed starts showing bullish content about Tesla. If you buy Bitcoin, You see content about institutional adoption and price targets of $500,000. The algorithm isn't trying to trick you, it's trying to engage you, but the side effect is to turbocharge your confirmation bias. You can spend hours a day consuming financial content and come away with greater conviction, but not with better understanding, because 90% of what you consumed just echoed what you already believed. The third psychological error that is destroying wealth now is what behavioral economists call mental accounting. But I see an amplified version that I call compartmentalized risk blindness. It works like this. Your brain naturally divides money into different mental accounts based on how you acquired or intend to use that money, and treats each mental account as if it were independent of the others. You have the mental salary account, where money is sacred and you are conservative. There is the mental bonus account, which is already money that you treat as available for further risk. There is a mental crypto account that is literal mind Vegas money, where losing 50% doesn't seem so bad because you mentally had already written it off as speculation. The devastating problem is that all of these mental accounts affect the same real net worth. If your mental crypto account loses $70,000, you cannot buy a house with $70,000 less just because you had mentally categorized it as speculative money. Let me give you a concrete example of how I saw this destroy someone. I met a tech executive in 2021 who had a net worth of $1,200,000. He had mentally divided it like this. $400,000 in index funds in the 401k he saw as untouchable and conservative. $300,000 in equity from his company that he saw as part of the compensation package and didn't think much about risk. $200,000 in crypto that he saw as high-risk, high-reward speculation. $150,000 on a rental property that he viewed as real estate insurance. $150,000 in a savings account as an emergency fund that he saw as zero risk. In his head, he had a very diversified portfolio with different levels of risk in different mental accounts. But here's what he didn't see, because mental math blinded him to the aggregate risk. The stocks in the 401k were 85% tech stocks, including 40% in the same Magnificent Seven. His company's equity was in a SaaS company highly correlated with tech. Cryptos were 80% in Ethereum and Bitcoin, which move with tech stocks. The rental property was in San Francisco, where real estate prices strongly correlate with the tech economy. Adding it all up, 82% of his real net worth was correlated with the performance of tech stocks. But the mental math created the illusion of diversification. Between November 2021 and October 2022, when tech fixed it, here's what happened. 401k dropped from $400,000 to $250,000. The company's equity fell from $300,000 to $80,000. Crypto fell from $200,000 to $50,000. Rental property that he needed to sell due to a job change sold for $110,000 versus the $150,000 he paid. Net worth went from $1,200,000 to $590,000 in 11 months. 51% destruction. And what made this psychologically devastating was that he thought he had been conservative by putting $400,000 into 401k and $150,000 into savings. Mental math created a false sense of security that masked massive concentration of risk. At Bridgewater, when we analyze portfolio risk, we completely ignore mental math or asset categories and only look at return correlations. It doesn't matter whether you call something retirement, speculation, or real estate. It matters whether when the market drops 20%, these things fall together or move independently. True diversification means having exposures that genuinely don't move together, not having the same risk under different names. The fourth psychological error is perhaps the most insidious because it looks like prudence, but is actually paralysis disguised as caution. I call this analysis paralysis driven by loss aversion. It works like this. Your brain is wired by evolution to feel pain from losses approximately twice as intensely as pleasure from equivalent gains. This makes evolutionary sense. Our ancestors who avoided losing resources survived longer than those who sought risky gains. But in financial markets, excessive loss aversion creates a destructive pattern. You become so focused on not making the wrong decision that you end up not making a decision at all, or you make decisions only when the emotional pain of not taking action outweighs the potential pain of loss, which is usually too late. Let me show you how this spectacularly destroyed assets in 2007 and 2008. I had a Bridgewater client with $23 million in portfolio in June of 2007. We showed him our analysis indicating that the housing bubble was peaking and the credit cycle was turning. We recommend reducing exposure to financials and increasing cash and treasuries. He intellectually agreed with the analysis, but was unable to act. Why? Paralyzing loss aversion. If he sold financials and they continued to rise for another 6 months, he would feel like he lost those gains. If he bought treasuries and yields fell, he would feel like he missed the opportunity to have bought earlier. The anticipated pain of getting the timing wrong outweighed the abstract pain of a future crisis. So he did what loss aversion usually does. Nothing. Analysis paralysis complete. He asked for more analyses, more scenarios, more second opinions, not because he needed more information, but because the information what he had required action, and action created the possibility of loss that his brain could not accept. Between June 2007 and March 2009, this $23 million portfolio fell to $9,400,000. 59% destruction. But here's the part that really illustrates the tragedy of loss aversion. In March of 2009, when financials were at an absolute bottom, when Bank of America was at $3 and Citigroup at $1, when it was objectively the best time in a generation to buy, he also failed to buy. Why? Same loss aversion. If he bought and fell another 20%, he would not be able to tolerate the pain of having bought at the wrong time. So he waited until May of 2010, when financials had already doubled from the bottom, when the pain of having missed the recovery finally overcame the fear of further loss. Loss aversion made him sell at the top for fear of losing gains and not buy at the bottom for fear of losing more. Mathematically, it is the most destructive behavior possible, but psychologically, it is the default pattern of the human brain. At Bridgewater, we combat loss aversion with what we call systematic rebalancing. We do not make discretionary decisions based on how we feel about potential loss. We have pre-established rules. If correlations change beyond threshold X, we rebalance Y%. If volatility reaches level Z, we adjust exposure by W%. This removes the emotional decision of the moment and replaces it with systematic discipline based on tested principles. The fifth psychological error that is destroying fortunes right now is what I call leverage-induced risk perception distortion. When you use leverage, whether it's margin on stocks, leverage on real estate via mortgage, or options that are implicit leverage, something fundamental changes in how your brain perceives and responds to risk. Leverage creates 3 lethal psychological distortions simultaneously. First distortion. Leverage makes you focus on potential upside and systematically underestimate real downside because your brain calculates return on the capital you put in, not on total exposure. You put $20,000 down payment on a $200,000 house. House appreciates 10%, $20,000 gain on your $20,000 invested. 100% return on your capital. Your brain fixates on that 100% and ignores that you have exposure to $200,000 of real estate market volatility. Second distortion, leverage artificially reduces your perception of risk because you don't feel the full weight of the position. It is psychologically easier to have a $100,000 position using $20,000 of equity and $80,000 of leverage than to have an unleveraged position of $100,000 using $100,000 of your money, even if the market risk is identical. Third distortion, leverage creates emotional decision urgency because when position moves against you, margin calls or fixed payments force you to make decisions in moments of maximum psychological stress, which is precisely when humans make the worst decisions. Let me tell you what happened to a trader I met in 2021 that perfectly illustrates these three distortions. He had $80,000 and started trading options on tech stocks. With options, you can control exposure from millions to tens of thousands. He purchased call options on Tesla, equating to exposure of $400,000 using $40,000 of his capital. Tesla is up 30% in 6 weeks. The options appreciated by 160%, transforming $40,000 into $104,000. 64,000 gain. First distortion activated. His brain calculated a 160% return on his capital, not the 30% that Tesla actually rose. This created a feeling that he had superior skill that generated multiple market returns. Second distortion activated. Controlling exposure of $400,000 with $40,000 seemed less risky than investing $80,000 directly in Tesla stock, because he didn't feel the weight of $400,000. It was abstract, just numbers on a screen. With Tesla's earnings, he purchased call options on Nvidia, equating to exposure of $1,200,000 using all $104,000. Over the next 3 months, Nvidia fluctuated wildly. It rose 8% one day, fell 6% the next. Third distortion activated. Options have expiration. Volatility was burning time value. He needed to make daily decisions about whether to hold or sell in a state of maximum stress, because losing everything was a real and close possibility. On a particularly volatile day, where Nvidia fell 9% in 2 hours, he panicked and sold everything at the bottom of the day, locking in a 70% loss. And $8,000. Nvidia closed the day just 3% below its open, and the following week was 10% above where it sold. Leverage had distorted his perception of risk across all 3 dimensions. It made him focus on exaggerated upsides, reduced perception of real exposure, and forced an emotional decision at the worst possible moment. $80,000 became $26,000 in 6 months. 73% destruction. And here's what makes leverage even more dangerous in 2026. Access to leverage has never been easier or cheaper. Margin rates falling. Options trading with 0 commissions. Crypto exchanges offering leverage of up to 100 to 1. Real estate with down payments of 3%. Each financial product is competing to offer more leverage because leverage generates more trading activity, which generates more fees. But leverage doesn't just amplify returns, it amplifies psychological errors. If you have recency bias without leverage, you double down on a winning position and eventually suffer a normal correction. If you have recency bias with leverage of 5 to 1, you quintuple a winning position, and a normal correction liquidates you completely. Leverage turns psychological mistakes from costs into catastrophes. At Bridgewater, we have an absolute rule about leverage. We never use leverage at a level that a reasonable market movement, defined as 2 historical standard deviations, could force liquidation of positions. This means that our leverage is calibrated not to maximize returns in normal scenarios, but to survive extreme scenarios that inevitably happen. Now let me connect these 5 psychological errors and show why their combination is so devastating. Normalcy bias makes you assume that recent trends will continue. Recency bias and confirmation bias create increasing conviction based on recent performance, not objective analysis. Mental accounting blinds you to the real aggregate risk of your portfolio. Loss aversion paralyzes you exactly when you should act. And leverage amplifies all four previous mistakes while distorting your perception of risk. When these five operate simultaneously, the result is not just bad, it is mathematically catastrophic. Here is a real case I observed closely that combined all five errors. A doctor in 2021 with $1,800,000 in net worth. Normalcy bias made him assume that tech stocks would continue to rise, as they have in the last 2 years. Recency bias made him give disproportionate weight to the 140% return that tech had in 2020, ignoring that this was a pandemic anomaly. Confirmation bias made him read only bull cases about tech and interpret every news as confirmation of permanent digitization. Mental accounting made him divide money into 3 categories: conservative retirement, which was tech-heavy index fund, investments, which were individual tech stocks, and speculation, which was crypto, without realizing that 89% was correlated with tech. Loss aversion made him not sell when signs of reversal began in November 2021 because he did not want to make losses or miss potential recovery. And leverage, he had used home equity line of $300,000 to buy more tech stocks in September of 2021. Between November 2021 and September 2022, the portfolio fell from $1,800,000 to $720,000. $1,080,000 of destruction. 60% gone. And because I had used leverage via home equity line, I was also paying $5,000 a month in interest on the $300,000 borrowed, which were now worth $110,000 on the market. The 5 psychological mistakes combined not only destroyed his wealth, they created a financial hole that would take years to dig out. Now, I know exactly what's going through your head after hearing these stories. The first objection I always see is, "But I'm different. I'm more careful. I do my research. I won't make these mistakes." Let me give you some brutal news. All the people I told you about in these stories thought that too. The doctor had a PhD in addition to an MD. The tech executive had a top school MBA. The trader had passed CFA Level 2. Intelligence does not protect you from psychological biases. Sometimes it even amplifies them because it gives you more confidence in your ability to avoid them. Studies in behavioral economics show that knowledge about cognitive biases has zero correlation with the ability to avoid them in practice. Knowing that recency bias exists doesn't stop your brain from giving disproportionate weight to recent events. It's like knowing that optical illusions are illusions doesn't make them disappear when you look. The only protection is systematic processes that force you to confront your biases, their intellectual non-awareness. Second objection I hear is, "But I can't act on everything. I need to wait for the right moment. I need more clarity about the direction of the market." Here's the uncomfortable truth. Waiting for clarity is a guarantee of acting too late. Clarity in markets only comes in retrospect. In June 2007, it was not clear that the housing bubble was bursting. It became clear in March 2008 when Bear Stearns collapsed, and at that point, it was too late. In January 2020, it was not clear which pandemic would cause a global crash. It became clear in March when markets fell 35% in 3 weeks. Too late. Waiting for clarity means waiting until everyone sees the same thing. And when everyone sees the same thing, it's already priced in. The time to act is precisely when it is unclear, when you have to operate based on principles and probabilities, not certainties. Loss aversion makes you want certainty before acting, But certainty in markets is an illusion that only exists after the opportunity has passed. Third objection, and the one that concerns me most, is, I understand all of this, but I will wait to see how the next few months develop before making changes. This is loss aversion, disguised as prudence. What you are really saying is that the potential pain of getting the timing wrong outweighs for you the potential pain of catastrophic loss. But here's the brutal math of waiting. If you wait 3 months and the market corrects 20% in that period, you have locked in a 20% loss that you never recover unless the market rises 25% from the low point just to break even. If you act now and the market rises another 10% before correcting 25%, you have lost 10% upside but avoided 25% downside. Mathematically, the cost of acting early and being wrong is always lower than the cost of acting late, but psychologically it seems the opposite, because loss aversion distorts your calculation. And if this content alerted you to psychological patterns that you recognize in your own behavior, leave a like now, because this helps the algorithm take this message to more people who need to confront these biases before destroying assets. And if you're not already signed up, sign up and hit the bell, because in the next few videos, I'm going to break down the specific systematic processes I use to counteract each of these 5 psychological errors, including the exact frameworks that Bridgewater has developed over 40 years to force principled decisions when emotions are screaming to do the opposite. Let me now give you the framework I developed over 4 decades to systematically neutralize these psychological errors before they destroy your wealth. I call this principles-based decision architecture, and it consists of 7 layers of psychological protection that work even when you are emotionally compromised. Layer 1 is what I call pre-commitment to rules during emotional neutrality. The idea is simple, but few execute it. You create specific, quantitative decision rules when you are in a neutral emotional state. Ideally, when you don't even have open positions or when markets are calm, and you commit to following these rules regardless of how you feel when the time comes to execute. For example, specific rule would be, if any individual position represents more than 8% of my portfolio, I automatically rebalance to 8% by selling the excess. It doesn't matter if the position is rising, and I think it will continue. It doesn't matter if I just read a convincing bull case. The rule was established in a moment of emotional neutrality based on the principle that concentration above 8% violates my risk tolerance, so I execute it mechanically. Another example rule would be, if portfolio drops more than 12% in any 30-day period, I immediately reduce equity exposure by 20% and increase cash by 20%. I don't expect to see if this is a temporary correction or the start of a bear market. The rule recognizes that my brain cannot make this distinction objectively in times of stress, so the decision was pre-made when I was calm. At Bridgewater, we have more than 200 such rules coded into our systems. They are not suggestions or guidelines. They are hard rules that execute automatically. This completely removes the emotional decision in the moment. Layer 2 is mandatory adversarial analysis for all convictions above threshold. For any position that represents more than 5% of the portfolio, or any view that you have high conviction, you are required to write, literally write, the best possible case for why you are wrong. Not a superficial case, like other people think differently, but genuinely the strongest argument against your position that you can to build. If you're bullish on a stock, you have to write 3 pages about why the stock should fall, using the best data and logic you can find. If you are convinced that rates will rise, you have to write a detailed analysis of why rates should fall. This breaks confirmation bias by forcing you to actively seek and process information contrary to your view. The act of writing is critical because it forces rigor that thinking does not. You can think vaguely about counterarguments, but when you have to write 3 coherent pages, you are forced to really understand the counterarguments. At Bridgewater, before making any major decisions, we present both the bull case and the bear case to an independent group that has no skin in the game, and they vote on which case is more convincing based solely on the quality of the arguments. If the bear case we build is more convincing than our bull case, we don't make the trade even if it is our original idea. Layer 3 is correlation analysis, ignoring asset labels. At least once a quarter, you take all your positions, completely ignore the names or categories, and calculate historical correlations of returns over the last 5 years, including stressful periods like March 2020. The goal is to see if what you call diverse is actually diverse. Take your stocks, real estate, crypto, private equity, everything, and run correlation matrix. If you find that 80% of your positions have a correlation above 0.7 with S&P 500, you have no real diversification. You have S&P 500 with extra steps. This breaks mental accounting because it forces you to see aggregate risk regardless of how you labeled the mental accounts. It may be uncomfortable to discover that your conservative retirement, your growth investments, and your crypto speculation all move together. But better to find out via analysis than via crash. Layer 4 is systematic rebalancing based on volatility, not views. Establish ahead of time that you will rebalance portfolio for target allocation when volatility reaches certain levels, not when you think the timing is good. For example, if VIX rises above 30, automatically reduce equity exposure by 15%, regardless of your view on direction. If VIX falls below 12, automatically increase equity exposure by 10%. This forces you to sell when markets are volatile and everyone is panicking, exactly when loss aversion would paralyze you. And it forces you to buy when markets are calm and complacent, exactly when normalcy bias would make you assume everything is fine. Remove timing decisions from the emotional equation. Layer 5 is leverage limits based on worst historical drawdown, not current margins. Never use leverage at a level that, if the asset's worst historical drawdown repeats, you will be forced to liquidate your position. For example, if you want to use margin to buy stocks and the worst stock drawdown was 56% in 2007 to 2009, your leverage cannot exceed the point where a drop of 56% leaves you with zero equity, which is approximately 1.3 to 1 leverage. This protects against the third leverage distortion, where you are forced to make decisions under maximum stress. If you have the buffer to survive a historical worst case, you are never in a position where you need to decide with a gun to your head. Layer 6 is recording yourself explaining major decisions for future review. Before making any investment above 10% of the portfolio, record a 5-minute video explaining your thesis, what upside you expect, what downside you are accepting, and exactly what conditions would cause you to exit the position. 6 months later, regardless of the outcome, watch the video and write an analysis of which parts of the thesis proved correct, which proved wrong, and whether you followed or ignored your own exit criteria. This creates an accountability loop that breaks recency bias because it forces you to compare your original analysis with what actually happened, not with the revised narrative that your brain constructs in retrospect. You will discover patterns in your mistakes. Maybe you consistently underestimate downside risk. Maybe you change midstream exit criteria when position moves against you. Awareness of these patterns via objective data from your own past decisions is infinitely more valuable than abstract awareness that biases exist. Layer 7 is external accountability.